Based on the numerous blogs on Bigger Pockets, Brandon Turner aims for $100 in cash flow for every unit that he buys. For example, if he buys a duplex, he wants to cash flow $200 minimum. But if he buys a property for $1 million, is it still a good deal if he only cash flows $100? While cash flow is a great metric to evaluate a rental property, it should not be the only metric you consider. And that's where cash on cash return comes in. Cash on cash return measures how much money or net profit is made on an investment as a percentage of the cost of the initial investment. It shows how effectively and efficiently investment dollars are being used to generate a net profit. Knowing the cash on cash return allows investors to assess whether putting money into a particular investment is worthwhile compared to another investment. The most widely used cash on cash return formula is annual cash flow divided by total cash invested. Calculating a property's cash on cash return is fairly straightforward if you buy a property with cash. Here's an example of a rental property that we purchased with cash. Let's say that you paid $250,000 in cash for a rental property. The closing costs were $10,000 and remodeling costs totaled $25,000. That brings your total investment to $285,000. Let's say you collect $1,500 in rent every month. After a year, you've earned $1,800 in rental income. Expenses, including property taxes and insurance, total $2,500. So that leaves your annual cash flow at $15,500. The property's cash on cash return is calculated by dividing the annual cash flow, in this case $15,500, by the amount of the total investment, which is $285,000. The cash on cash return calculates to 5.4%. Calculating the cash on cash return on financed transactions is a bit more involved. For example, assume you bought the same property at $250,000, but instead of paying cash, you took out a mortgage. Let's say you paid a 20% down payment on the purchase price of $250,000. This calculates to a $50,000 down payment. The closing costs were $10,000 and remodeling costs totaled $25,000, just like our example before. That brings your total out-of-pocket expenses to $85,000 now. You collect $1,500 in rent every month. After a year, you've earned $18,000 in rental income. For expenses, we must now consider the ongoing costs with the mortgage. The mortgage was a 30-year fixed rate at 3% on the borrowed $200,000. The monthly principal and interest payment is roughly $843. We'll add $208 a month to cover taxes and insurance, making your total mortgage payment $1,051. Your monthly cash flow for the property will be $1,500 rent minus $843 in mortgage payment and minus $208 for property taxes and insurance. That leaves your annual cash flow at $5,384. The property's cash on cash return in this case is calculated by dividing the annual cash flow, $5,384, by the amount of the total investment, which was $85,000. The cash on cash return here is 6.3%. The cash on cash equation might seem simple enough, but keep in mind that there are a number of real estate variables that can impact the cash on cash return formula. These include repair and maintenance expenses, as well as leverage, money borrowed to make the initial investment. And as you can see from the example above, financing terms can impact the overall investment. In a previous video linked below, we discussed the importance of the cap rate. The cap rate is the annual return from operations that an investor would expect to receive if the asset were purchased for all cash, and helps indicate the rate of return that investors can expect to generate from an investment property. While the cap rate compares the purchase price of a property to the income it generates, the cash on cash return tells you how much return on the actual cash you invest. With that being said, the cash on cash return for an all cash purchase will be the same as the cap rate. To ensure a profitable rental property, you must actively work to boost the cash on cash return by 1, cutting costs, 2, ensuring a steady occupancy, and 3, increasing rent. Cutting costs means limiting expenses, which is where maintenance expenses can play a part. Keeping up with maintenance can boost your cash on cash return over the long term. Meanwhile, making sure you have your property rented consistently is the biggest driver for income. Having a high turnover rate means you're missing out on income and having to spend more on expenses to find and vet tenants. And lastly, the other key to increasing cash on cash return is increasing rent when possible. Increasing rental rates will help investors better manage rising expenses, which can include taxes, insurance, and repairs. So, what is a good cash on cash return? On average, the stock market returns between 6 and 7% over the past 100 years. We want to outperform the stock market, so we should aim for a cash on cash return greater than 8%. Let's run an example here. Let's say we bought a home for $50,000 in cash. If you cash flowed $100 a month, then that's $1,200 a year. If you divide $1,200 by $50,000, you get a cash on cash return of 2.4%. While the property cash flows well, based on the 8% benchmark, you could potentially earn a better return if you invested that same amount in the stock market. Now let's dig into some frequently asked questions. How does depreciation impact cash on cash return? Depreciation is not generally included in cash on cash calculations, but for real estate investors, the depreciation expense can be a useful tool that makes rental property investing more advantageous than different investments. What if I can't find an 8% cash on cash return property? We know that cash flow is just one of the benefits of rental property investing, and appreciation is also a part of the fun. When you're not able to find a cash on cash return above 8%, consider making an exception if the property is in a market that is likely to appreciate in property value. For me, there are different thresholds for different types of markets. In markets that appreciate, personally, I want a minimum cash flow of $100 per month per unit, and I want a minimum 8% cash on cash return. In markets that do not appreciate, I want a minimum of a cash flow of $200 per month per unit, and I want a minimum of 10% cash on cash return. Can cash on cash return be negative? Cash on cash return is simply the amount of profit you make from an investment property. This percentage could be positive, indicating that the investment made money, or it could be negative, indicating that you lost money. Other factors such as high turnover rate or long vacancy periods can also drive down the cash on cash return. Other factors such as high turnover rate or long vacancy periods can drive down the cash on cash return to a negative number. Calculating the cash on cash return with the rental property dashboard is quick and easy. The rental property dashboard is a free mobile app available to download for all Apple and Android devices. Download it today and calculate your cash on cash return to evaluate your current properties and research potential opportunities. And if you haven't already, please click the like and subscribe button below. Also follow us on Instagram, Facebook, and Twitter, where you can directly talk with us. That's going to be it for today's video on cash return. Stay tuned for the next one.